Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at how many traders seek out entry points which allow them to place their stops in areas that have multiple support or resistance levels between their entry price and their stop level. And on the flip side of that, have few, if any, support or resistance points between their entry price and their profit target. In today's lesson, we're going to look at another factor that many traders consider when thinking about their stop placement, which is the use of technical indicators. So let's get started.
Okay, so as you hopefully remember from watching my previous lessons, we've already covered two indicators and gone over specific strategies on how they can be used to set stops, which are the average true range and the parabolic SAR. While these indicators were designed specifically to help traders gauge where to place their stops, many of the other indicators which we've looked at when looking at how to pick entry points can also be used when deciding where to place your stop. With this in mind, the question then becomes, with all the options that are available, how do you choose the correct indicator, or which indicator, if any, to look at when deciding or when thinking about your stop levels? Which indicator, if any, you choose for your money management strategy or for specific trades is really going to depend on the strategy and time frame and a number of factors. But as a general rule, most traders will, we'll think about it this way: if they use an indicator to enter a trade, then they're going to keep an eye on that same indicator, and if the indicator begins to signal something opposite from their rationale for entering the trade, then they'll probably think seriously about changing their mind on the trade that they're in and exiting out, even if they have a hard stop in that's not been hit yet. So let's just look at a quick example here. Chart of Starbucks and ADX here on the plotted below the chart, which we've looked at in past lessons. And so let's say you notice this uptrend in Starbucks here. You didn't get in on it the first time, but you feel like Starbucks is a winner over the long term from all the analysis that you've done, and you decide that if the market does start to trend again after this little range here, that you want to get in, and you're going to use the ADX and the break above that resistance line to decide whether or not and where to buy. So you get the break above the resistance line, as you can see there on the chart, and you have the rising ADX rising towards 40, so you're signaling a pretty good strong trend there. So you decide to buy, and you get into the market, and using some of the lessons that we've just gone over, you decide to place your stop below this trading range here. So you've got some nice support in between your entry price and your stop, and that fits within your risk parameters and all that good stuff which we've covered. Now, as the market continues to go higher, if you notice here, the ADX starts to fall off, and it even goes below 20, which is a real sign that the market is not in a trend, and it's probably that's a real kind of reversal sign there for this chart. Very bearish, for the trend there. So even though you haven't been stopped out at that point on your hard stop, a lot of traders may consider exiting that trade because a good part of the original analysis that they decided to get into the trade on has now is now not valid anymore, has now reversed itself. Okay, and that example with the ADX, I mean, that's just one example that can be applied to pretty much any indicator and any analysis that we're talking about here. If the reason why you got into the trade, or a big piece of the analysis that you got into the trade on, changes direction, then you may want to consider changing direction of your trade or exiting out of the trade altogether. Okay. One indicator which a lot of times, even if traders don't use to enter a trade, that they'll still have on their charts is the 50 and the 200-day moving average. The 50-day moving average tends to be representative of the intermediate term trend, and the 200-day moving average tends to be representative of the longer term trend. And because of this, many traders watch these moving averages and what price does around them, and if the 50-day moving average crosses below the 200-day, that's going to be considered bearish. Similarly, if price breaks below the 200-day moving average or the 50-day moving average, that's going to be considered bearish, and vice versa. So you can see see here, there's a chart of the Dow Jones Industrial Average, and the you see the 50-day moving average there in blue and the 200-day moving average there in yellow. And you can see we've recently broken that, and a lot of people are pointing to that, the fact that price is below the 200-day, and the 50-day moving average has also crossed below the 200-day as a very bearish sign for the Dow. Okay, now as you probably realize by now, if you're thinking about this, basing stops on indicators doesn't give you the opportunity to put a hard stop in place in the market, because there's no way for you to know where price is going to be when the indicator does something that's going to want to make you exit a trade. So because of this, you're always going to want to use a hard stop using one of the other methods that we've talked about, or some of the things that we're going to talk about in future lessons, so you can make sure that you always have a stop in place, and not waiting for something that might not happen with the indicator, as the market continues to move against you and you lose more and more money. Okay, and that kind of leads us into our next series of lessons, which is going to be on trailing stops, which we're going to talk about how to move your stop up along with the market as the trade hopefully moves in your favor. Okay, as a little bit of as a side note, I just wanted to point out a couple things on this chart that really don't have anything to do with this lesson, but I thought people might find interesting. If you notice here, not only do you have the market below the 200-day moving average pretty handily, and the 50-day now below the 200-day pretty handily, but you also have a head and shoulders top in place here, and should the market break through this support level there's a lot of white space below that. So a lot of people are pointing to these facts as very bearish signs for the Dow. Okay, the purpose of the InformedTrades.com community is to hopefully put together a community of traders who want to come together and learn together without all the hype that's associated with most trading education. So if you haven't done so already, I encourage you not only to visit the InformedTrades.com community, but every page on the site has a comment section, so I encourage you to actively participate and help build the community by sharing your comments and questions where applicable. That's our lesson for today, and tomorrow's lesson we're going to look at trailing stops. So hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below, and good luck with your trading.